The member for Bradfield.
Thank you very much, Mr Deputy Speaker. I'm very pleased to be able to rise to speak regarding the Banking Amendment Covered Bonds Bill 2011. And in the brief time that I have available to me, I'd like to make 3 points in relation to this important piece of legislation. Firstly, that the Coalition's approach to this bill is one of a constructive opposition. Secondly, I'd like to talk about the way that covered bonds offer the potential to assist the Australian financial sector, and the banks in particular, to raise capital, and why that matters. And thirdly, I'd like to address the key issue of the impact of covered bonds on depositors and how concerns on that front are addressed as part of this structure. Mr Deputy Speaker, I'm pleased first to turn to make the point that on this bill, as on so many other bills, the opposition is playing a constructive and cooperative and value-adding role. The appearance of politics can sometimes differ from the reality, and there are some in this place, I'm sorry to say, who for their own purposes seek to create the impression that the Coalition is obstructionist in its approach to opposition. This is unfortunate and is not in accordance with the facts, Mr Deputy Speaker. And I know that your own commitment to a close analysis of the facts will be satisfied when we look at the statistical evidence. The government likes to claim that, for example, as at late September 2011, that over 190 bills had been passed by this parliament. The reality, Mr Deputy Speaker, is that approximately 170 of those were ultimately passed without a negative vote from the opposition. And indeed, in a number of cases, quite a number of cases, the opposition engaged very constructively, offering helpful suggestions and constructive amendments. In some cases, our suggestions were accepted and our amendments were included in the bill as it passed into law. Only a relatively small percentage of bills, therefore, Mr Deputy Speaker, have been voted against by the Coalition. And I think it is important that we put that on the record so there be no misunderstanding in the face of these unhelpful claims which are sometimes made by the government, claims which are not in accordance with the facts. Mr Deputy Speaker, this is an opposition which approaches the government's legislative agenda with an open mind, and we are willing to work constructively with the government to improve legislation where that is appropriate. Mr Deputy Speaker, this bill, the one we are debating today, the Banking Amendment Covered Bonds Bill, is one which the Coalition welcomes and the Coalition supports. Now, that is not unrelated to the fact, Mr Deputy Speaker, that the idea came from this side of the House. In October 2010, the Shadow Treasurer, the member for North Sydney, my neighbour in the northern suburbs of Sydney, announced the Coalition's 9-point banking plan. And one of those 9 points was to, quote, commission a resolution to the debate about whether banks should be able to issue covered bonds in the same way other jurisdictions allow their banks to, which provides a more affordable line of credit. Imitation is the sincerest form of flattery, and 2 months later the government was eager to flatter the opposition when, in announcing its own banking plan, it included the following item, quotes, allowing all banks, credit unions and building societies to issue covered bonds, to broaden access to cheaper, more stable and longer-term funding. Mr Deputy Speaker, the bill which is in front of the House this afternoon implements that measure. It is perhaps not surprising that the Treasurer has found it necessary to draw on ideas from this side of the House, because his own contribution to the performance of not only Australia's banking sector but Australia's wider economy has been a remarkably undistinguished one. Under the present Treasurer, Mr Deputy Speaker, we have seen the merger of Commonwealth Bank and Bank West and Westpac and St George, leading to an unprecedented increase in concentration and a corresponding reduction in the intensity of competition. We've seen, on the watch of the current Treasurer, a panicked introduction of a $1 million guarantee for depositors. And this follows Australia having a record for many, many years of not needing to have such a government guarantee. We now, of course, with this guarantee in place, face the well-known problem of moral hazard, a problem in which bank managements are aware that should they take excessive risks—
The member for Bradfield will be seated. The Parliamentary Secretary on a point of order.
Yes, I'd like to raise the point of relevance. I've waited for the first 5 minutes of the member's address and he's done everything but talk about the legislation at hand and engaged in an attack on the Treasurer.
Thank you. Thank you. The member for Bradfield has been speaking now for 5 minutes. I'd ask the member and all members that wish to contribute to this debate to be highly relevant to the legislation before them, which is the Banking Amendment Covered Bonds Bill 2011. So I'd ask the member for Bradfield to be very relevant.
Deputy Speaker, I am being highly relevant. In fact, I've used the term covered bonds on a number of occasions, and I am explaining the policy context in which this bill comes before the House. And a critical part of that policy context, Mr Deputy Speaker, is the fact that the government was eager to take up the opposition's ideas because its own ideas have been either non-existent or very poor.
The member for Bradfield will now contain his information and comments to the legislation, please.
I continue to do that, Mr Deputy Speaker, as I have done consistently
for
the last
eagerly.
5 or 6 minutes. And, Mr Deputy Speaker, I now turn to the second point which I wish to address before the House this afternoon, which is the improved capacity which covered bonds offer to banks to raise capital. That is at the essence of the policy intention behind this bill. And as I indicated, Mr Deputy Speaker, it is a much better approach to economic management than, for example, the approach of this government in introducing deficit after deficit. We've seen deficits of $26 billion, $56 billion, $49 billion and this year $23 billion. And of course those deficits simply put upward pressure on interest rates and increase the desperate claims which the government is making on the financial markets. A much more prudent approach to banking policy and economic policy is the one which is contained in this particular bill, and that is the introduction of covered bonds. Mr Deputy Speaker, it's an uncontentious proposition, which I'm sure even the Assistant Treasurer will agree with, that banks play a critical role in our economy as providers of debt capital, and that is vital for home buyers, it is vital for business, it is vital for growth in our economy. Now, much of the money which banks lend out comes in turn from the money which is put on deposit with them. But as we all know, Australian banks are not able to source all of their lending from the money which is on deposit with them. According to the Reserve Bank of Australia, as at June 2011, the gap between the deposits held with authorised deposit institutions and loans made by authorised deposit institutions, that is to say, the amount which needs to be secured from other sources, was $700 billion. And it is that gap and the need to fill that gap which underpins the policy logic for allowing banks to issue covered bonds. The position is improving, Mr Deputy Speaker. Domestic deposits now make up around half of the bank's sources of funds, up from 40% in 2008. But by any measure, there still remains a significant amount of funding which must be obtained from sources other than deposits. A key means of filling that gap is the issue of bonds and other financial instruments by banks. And that is where covered bonds come in. They are designed to be another form of bond which a bank can issue to tap into the wholesale funding markets with features which make them attractive to investors and in turn allow banks to raise funds on attractive terms. In that sense, Mr Deputy Speaker, they are a form of securitisation, with some important variations which I will come to. Securitisation is a sector in which I have had, or a form of financing in which I have had some interest since my days as a banking and finance lawyer at Mallisons in the early 90s, when I had the opportunity to work on some of the earliest securitisation transactions in the Australian market, including the establishment of RAMS. Now, securitisation has subsequently got something of a bad name following the global financial crisis, but at heart it is a sensible and useful financial technique under which a bank takes a pool of mortgages, for example, sells that pool of mortgages to a special purpose vehicle. In turn, the special purpose vehicle issues bonds, which are backed by the pool of mortgages, and funds the purchase from the bank with the proceeds of the bond issuance. And in turn, the bondholders are repaid out of the mortgage cash flows. As we all know, securitisation went off the rails because banks started paying less attention than they should have done to the credit quality of the underlying mortgages, in part because with the mortgages having been sold, they no longer had much of an incentive to have an ongoing interest in their credit quality. Mr Deputy Speaker, I want to put to the House this afternoon the proposition that covered bonds can be thought of as a form of securitisation, in which the holder of the bond issued by the special purpose vehicle also has a right of recourse against the bank if the asset pool is inadequate to repay the bonds. That is to say, the bondholder also has the benefit of a guarantee given by the bank. Now, I hasten to add, Mr Deputy Speaker, that there are some important differences. In particular, a covered bond is issued not by the special purpose vehicle but by a regulated credit institution. But there is an important similarity, of course, which is that the bondholder continues to have security over the assets held by the special purpose vehicle. That is to say, the core idea remains the same. Bondholders have their returns funded out of a pool of assets, very typically mortgages, and in the case of covered bonds, this pool of assets is called the cover pool. Mr Deputy Speaker, there is a significant covered bond market in Europe and elsewhere in the world, but to date Australian banks have not been able by law to issue such bonds and hence tap into that market because, as we have heard, of the inconsistency between covered bonds and the absolute primacy of the claims of depositors in an insolvency. Now, Mr Deputy Speaker, the attraction of banks being able to issue covered bonds is that they typically allow banks to obtain funds more cheaply than they may be able to do so using other forms of financing, and furthermore, covered bonds typically have longer terms than other kinds of wholesale financing and funding. As we saw in the 2008 crisis, where wholesale credit markets dried up, banks with a heavy reliance on short-term funding were very exposed. If they could not roll over their bonds or notes, they faced a liquidity crisis and, in turn, a solvency crisis. There are accordingly important systemic benefits of allowing banks to issue covered bonds, as it will allow them to access a more stable form of funding, and in turn that contributes to the stability of our financial system. This combination of longer terms and lower costs will provide an important advantage to Australian banks, and provided that competition is working effectively in the banking sector, those benefits will in turn be shared with the bank's customers. Let me turn thirdly and briefly to the question of the impact on depositors, because the point has been made that covered bonds do represent a change in the priority which banks' creditors enjoy. Historically, depositors have had the first priority over all other unsecured creditors of banks. Now, I should here highlight, Mr Deputy Speaker, that the priority is only over other unsecured creditors, not over all creditors. That is an important distinction, and one which means in practical terms that the value to deposit holders of the existing priority arrangements can be somewhat overstated. Even so, it is a priority which should not be lightly set aside. That is to say, the basis for giving the holders of covered bonds priority, with deposit holders now to come second, should be very tightly prescribed. And that is done through this legislation in several ways. Firstly, through safeguards in relation to the cover pool, that is to say, the special purpose vehicle. The cover pool is required to contain 103% of the value of the loan, and there must be a cover pool monitor. The second way in which the legislation limits the impact of this change in priorities is that there is a cap on how much of its assets an ADI can contribute to the cover pool, and that cap is set at 8%. In turn, this limits the amount of covered bonds that the institution can issue. Thirdly, these arrangements will be supervised by APRA, the Australian Prudential Regulation Authority, and it will set prudential standards covering the issue of covered bonds. These provisions, in turn, will lower the risk of the loan. Therefore, Mr Deputy Speaker, let me conclude by making the observation that we are a constructive opposition, and we have brought to bear our constructive perspectives on this particular policy area, going so far as to indeed promote the concept of covered bonds, and we are pleased to support this legislation because it gives effect to an idea that has considerable merit.